Ladies and gentlemen, good day and welcome to Senores Pharmaceuticals Limited Q1 FY26 earnings conference call hosted by Ambit Capital Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. Please note that this conference may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Pranav Chawla from Ambit Capital. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Ambit Capital, I, Pranav Chawla, thank the management of Senores Pharma for providing us this opportunity to host the 1Q FY26 earnings call. Today on the call, we have the following members from the management: Mr. Swapnil Shah, Managing Director; Mr. Sanjay Majmudar, Chairman; Mr. Dhaval Shah, CFO. I now hand over the call to Mr. Swapnil Shah to walk us through the quarter. Thank you all. Over to you, sir.
Thank you. Thank you, Pranav. Good afternoon, everyone. Thank you for joining us on Senores Pharmaceuticals Limited's Q1 FY26 earnings conference call. Along with me on the call, we have our Chairman, Mr. Sanjay Majmudar, our CFO, Mr. Dhaval Shah, and our SGA team, our investor relation partner. We have uploaded our results, press release, and investor presentation on the stock exchanges and company's website. I hope everybody had an opportunity to go through the same. Continuing on our established strategies, we have delivered a very healthy performance across segments in Q1 FY26. Our consolidated revenue for Q1 FY26 grew by 72%. Our EBITDA and PAT grew by 60% and 95% respectively on YOY basis. We remain confident of delivering 50% growth in top line and about 100% growth in PAT for FY26 over FY25. Our current business is undergoing a structural advancement which will provide better market visibility and support the growth momentum for us over the medium to long term. Speaking about segmental performance, our revenue from regulated markets grew about 69% in Q1 FY26 on YOY basis, reflecting the strong and resilience of our product and the market we serve. The growth was also aided by the contribution of our CDMO-CMO segment this quarter. On a QOQ basis, revenue has grown by 40%. In addition to our in-house product development, the acquisition of ANDAs from Dr. Reddy's, Breckenridge, and Wockhardt has significantly strengthened our pipeline. These acquired products will be launched in a phased manner over the next few quarters. Notably, the growth achieved in this quarter does not include any revenue contribution from the acquired portfolio. Revenue from these assets is expected to start contributing from the second half of current financial year, with the full impact becoming visible from FY27 and onwards. In Q1 2026, we received USFDA approval for 4 products, taking our portfolio of approved products to about 70 as of end of this quarter. We also commercially launched 2 new products, bringing our total commercialized portfolio up to 24 ANDA products as of June 30th, 2025. For FY26, we plan to launch approximately about 15 to 16 ANDA products, with the majority scheduled for rollout in the second half of this year. In the regulated markets, a large part of our product portfolio has potential to cater to government contracts and the controlled substance category. Unlike many of our competitors who largely focus on the retail side of the business, our ability to supply to the government channel sets us apart. This access provides us with stable and consistent demand for our products, supported by long-term contracts with fixed pricing structures. As a result, we face comparatively lower risk of price erosion and are able to build more predictable and sustainable revenue streams, giving us a clear competitive advantage in the market space. Speaking on the tariff situation, it is very difficult to predict the course of action that US government will take. Irrespective of what the outcome is, we believe Senores is well positioned to remain largely insulated from any tariff-related developments. Our entire formulation manufacturing is done locally in the US as we speak. In terms of APIs, we procure very small quantities from China and some quantities from Europe. In case of any escalation of tariffs for this region, the impact on our business would be negligible. Coming to our CDMO-CMO segment, we are witnessing a steady traction of scaling up our operations on both our CDMO-CMO segment. We have added about 5 new products in CDMO-CMO segment in Q1 FY26. Our portfolio now stands at about 27 products. We have more than 50 products in pipeline as of June 2025. Again, the experience in our CDMO-CMO segment comes from our ability to manufacture locally, our end-to-end solution to our partners from regulatory to manufacturing and then post-approval regulatory support, develop and manufacture controlled substance. The D and BA certifications for our manufacturing facility in the US gives us a considerable advantage over competitors. All in all, the regulated market business, which is our largest vertical, continues to show consistent growth driven by portfolio expansion and increase in market penetration. Our existing portfolio in the pipeline in the one product segment, coupled with our contracts in and on CDMO-CMO segment, gives us a good visibility for the year ahead in the regulated markets. Also, the upcoming facility expansion in the US will provide an additional growth driver. We expect the third manufacturing line in the US to be operational by Q3 FY26 and the fourth line towards the end of financial year 2026. This expansion will take the oral solid capacity at our US manufacturing plant from 1.2 billion units to almost 2 billion units. After the completion of 4 lines, we would set up our sterile manufacturing in the US. Coming to the emerging market business, we have received about 23 new product approval during this quarter, taking our total product approval to 308 as of 30th June 2025. We have further 719 products under registration. We anticipate that the ongoing shift in our product portfolio towards more niche molecules combined with our evolving go-to-market strategies will result in a significant improvement in realization. This, in turn, is expected to drive strong growth and enhance the overall profitability of our emerging market business. We are seeing the result of this initiative in Q1. Our realization has increased from 1.2 to 1.3 per unit last year to almost 1.8 rupees per unit today, with a revenue growth of almost 32% on a YOY basis. The emerging market business is showing promising signs both in terms of growth as well as profitability. We will continue to focus on a niche segment of the product along with expanding its presence in mid-tier markets. We are also continuously working on streamlining our direct models in emerging markets. That said, we do not anticipate any significant changes to our consolidated revenue mix on a steady-state annualized basis. Regulated markets are expected to continue contributing around 60 to 70% of total revenue, with emerging markets continue accounting for approximately about 30%. Margins may vary slightly from quarter-on-quarter basis, depending upon the relative contribution of regulated and emerging markets business. However, with the expected improvement in profitability from emerging market, we foresee our consolidated EBITDA stabilizing at around 15 to 70% range on a sustainable annualized basis. Looking ahead, our backward integration strategy will play a critical role in strengthening our supply chain, driving sustainable growth across both our business segments. Operations at our recently commissioned API facility in Chhatral are progressing as planned with a capacity of approximately 100 to 150 metric tons per year. This facility is significantly larger than our first API in Naroda that we have. We are currently in the process of filing for DMF for FDA approval for the new API facility. Once approved, it will be a key milestone and further bolster the regulated market business. In the initial phase of operations, we intend to focus on manufacturing APIs where the cost advantage of in-house production over external sourcing is substantial. This strategic approach will not only enhance our margin but also improve supply chain reliability and long-term competitiveness in the business. On India branded generics business, the injectable segment has gained significant momentum. In recent months, our monthly revenue run rate has nearly doubled, reaching to almost 2.5 crores. We have been increasing our field force in the branded generic segment, expect to be present pan-India by end of FY26. The branded generics business is expected to surpass revenue of 50 crores in FY26. Also, we are happy to report that we have achieved positive operating cash flow in Q1 FY26. Our cash flow trajectory has shown consistent improvement, and we are confident in our ability to sustain and build on this momentum going forward. Our performance from the previous quarter to this quarter clearly shows a positive trend, and we expect to continue improving it as we progress deeper into FY26. In view of our product launch timelines, the second half of the year will be bigger than the first half of the year in terms of all business metrics. We have been delivering our commitment in terms of income and profitability, reinforcing the strength of our strategy and execution. Our focus remains firmly on established business model across both regulated as well as semi-reg emerging markets. We believe there is a long and promising growth runway ahead for Senores. We are all positioned to capitalize on these opportunities. Backed by deep industry expertise and years of experience, we are confident in our ability to drive sustained profitable growth going forward. With that, I would now like to hand over the call to Mr. Deval Shah, CFO, to take you through the financial highlights for this quarter. Thank you, and over to you, Deval.
Thank you, Swapnil. A warm welcome to everyone on our Q1 FY26 earnings call. I will just take you through our financial and operational performance for the quarter. Our consolidated income for the quarter stood at 138 crores, reflecting a strong growth of 72% on YOY basis. This was driven largely by the regulated market business, where there was little contribution from CDMO and CMO segment in the same quarter last year. On QOQ basis, also consolidated revenue has grown by 15%. EBITDA for Q1 FY26 stood at 34 crores, reflecting a growth of 60% on YOY basis. EBITDA margin came in at 24.8%, dropping by around 170 BPS on YOY basis. However, on sequential basis, our margin has improved by around 360 BPS. We request everyone to look at our business on an annualized basis, since there can be fluctuations in the quarterly trend on account of product mix that gets averaged out on an annual basis. On an annual basis, we'll see the company in a stable EBITDA margin of 25 to 26%. In Q1 FY26, there is some impact on EBITDA on YOY basis due to increase in the employee costs and other expenses of the API unit, which has to give in the revenue now, which will give us the revenue in current second half. Profit after tax for the quarter grew by 95% YOY and came to rupees 21 crores. During the quarter, we had a positive operating cash flow of around 11 crores. Coming to our segment-wise performance, revenue from regulated markets stood at 90 crores, growing by a robust 69% YOY and 40% QOQ. EBITDA margin in the regulated market stood at 35.5%. As revenue from emerging market grew by 32% YOY and stood at 29 crores. EBITDA margin in the emerging market stood at a stagnant 6%. However, the domestic branded generic business revenue grew to 8 crores, growing by more than 4x on YOY basis. To summarize, we have witnessed a healthy performance across segments in the quarter, and we are well positioned to sustain this momentum over the full year. We are confident of delivering sustained profitable growth going forward. With this, I would now like to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Kiran D from Table Tree Cap. Please go ahead.
Thank you, sir. Thank you for the opportunity to ask question. Fantastic results. Many congratulations. Sir, I had a more strategic question than the details of the numbers per se. Sir, in your presentation, you did call about controlled substances. Sir, if you could just give a bird's-eye view of how this controlled substances business actually works in the U.S. Is it tender-based? Is it retail? Is it government-driven? And given that this is only a DEA-approved facility, I'm assuming it's scheduled to drugs only from a controlled substance perspective. What are the typical margins? Again, I'm not looking for exact numbers. I'm looking sometime in the range, right? So 20 to 25% or 35 to 40%. That's the range that I'm looking at. If you could just explain the mechanics of the controlled substances business, sir, in terms of revenue profile, margin profile, and how this business actually works, it will be really helpful for us to understand as investors.
Yes, thank you. So I would just give you an overall perspective. Probably would be difficult to give you as a segment revenue and then profitability on that particular segment. So largely controlled substance is quota driven, right? So DEA, that's a department that US government runs, hands out the quota to each approved player for that particular product. And usually it is distributed equally among all the approved players that's out there. So it's a quota driven. From infrastructure standpoint, we need to have a cage and vault and then all the systems that is required on our DEA side. We get audited very regularly from DEA since we are handling those sensitive substances for our manufacturing. So that's overall perspective on the controlled substance as we speak.
And just to add, most of our customers, so we don't do direct tendering, but it is either as a part of the CMO, CDMO, or our third-party marketing partners who are handling this with the customers.
Got it, sir. Got it. And sir, again, I'm not looking for, if you can just give a broad margin profile, sir, is it like 25 to 30, 35 to 40? Again, I'm not looking for exact numbers, I'm just looking for a broader range.
See, as a matter of clarity and strategy, we generally would want to talk only of a consolidated regulated market margin where we have this year reported about 35-36%. So, it's a mix of various products and multiple business segments. Let's take it as US as a whole. That would be better.
Got it. I mean, will it be in line with US? I mean, I'm just worried that margin diluted, sir. That's why I'm asking this question.
No. I mean,
so margin dilution because of controlled substance, we don't see any possibility. In fact, not many companies have that kind of capability to handle controlled substances. Plus, we also do R&D, right? So at the CDMO component of D, which is development, we do extensive development of controlled substance in the US because we have a full operational R&D lab set up at our facility in US. So, that gives us an edge, and that's how we are able to do a lot of those transactions, both on a CMO, CDMO, as well as our own product portfolio on the controlled substance side.
Got it, sir. Got it. Sir, then my second question is, sir, on Atlanta, we have had 1 billion units capacity. We are doubling up to $2 billion. In terms of revenue potential from US, again, I'm not asking for exact numbers. I'm looking more from a broader split. If you look 2 years ahead, right? If you look 2 years ahead, our US revenue or the regulated US revenue, what portion would be coming from this Atlanta plant, sir? Again, rough numbers. I'm just trying to look at the split between India and US from a US revenue perspective.
This year from our US regulated side, we expect to do about 400 odd crores. And on a steady state going forward basis, you can assume between 20 to 30% CAGR growth, That's what we anticipate and that's what we feel we'll be able to achieve. I think at this point of time, I think that should be good enough for us to take that forward.
And just to add and answer your question, currently entire revenue of US is coming from US side.
Okay. Okay. Got it, sir.
Yeah.
Got it. Sorry, I missed that nuance. Okay. From here on, again, we'll try for Ahmedabad as well, but currently everything is from the U.S. side itself. Got it.
Yes.
Absolutely correct. Yeah. Anyway, controlled substances and government has to be from U.S. Currently, most of the retail is also from U.S., so you can take it like that.
Perfect, sir. Perfect. Very helpful. Thank you so much, sir. All the best.
Thank you.
Thank you. The next question is from the line of Rudraksh Raheja from iThought Financial Consulting. Please go ahead.
Yeah, thanks for the opportunity, sir. Congratulations on a good set of numbers. So my first question is, could you give us the split between CDMO and this formulations business in the regulated markets?
All businesses are formulation, actually. So CDMO, CMO, and own products, that is what you are asking?
Yeah, that is what I'm asking.
So in the current quarter, I would say that CDMO, CMO was about 28 crores, and rest all was own products. But again, this is not a trend. It all depends on which particular quarter, what is the demand position. But overall, annually, whatever I achieve, you can say that generally the split will be almost equal.
Okay. So going forward, we should assume it should be 50-50.
Again, it's very difficult. It will depend upon the order inflow and the kind of business that we are looking at. But you may consider this to be broadly in sync with our overall strategy of keeping it almost equal.
Understood, sir. And in the regulated markets business, sir, could you give me how much do we get it from the government sector? I think you touched upon that in your initial remarks also.
Yeah. So currently, almost our 60 to 70% business is between government and controlled substance of overall pie of the business that we have from the US. And the remaining about 30-odd% is between a specialty and retail side of the business. So large part of our existing business goes into government and controlled substance.
Just to add, I think we are not dealing directly with the government again. This is just to our partners that they supply to the government. We don't supply directly to the government.
Understood, sir. And sir, going forward, do we see this split changing in any way?
No, I think it should be same.
It should be the same going forward as well, because that's been a part of our strategy, right? That's where we leverage upon our local manufacturing in the US. So that's where the whole CDMO place comes in for us, right? So we don't expect that split to change going forward as we speak.
And sir, within this government and controlled substance business, I think you mentioned something like they have more stable contracts and stable margins, while the retail side would be more volatile comparatively. Is my understanding correct regarding this?
Yeah, that's correct. So usually national contracts for government are awarded for 5 years with a 1 to 2 year of extension, on the national contract. The price is stable, the volumes are stable. So, your predicting of cash flow becomes very, very consistent on those government national contracts that you bid for and you win and you supply, right? So, it's different from how the retail market functions, where there will be more volatility and fluctuation in terms of how the businesses are done.
But in terms of the percentage profitability, own product margins would be higher because there are 3 distinct revenue streams that we have talked about. That is the licensing fee, COGS, and then the profit share. So as a percentage, yes, I think your own product portfolio would have higher margins. Just for your reference, that's all.
Understood, sir. I'll come back in queue for more questions. Thank you.
Thank you. Before we take the next participant, we would like to wish that you may press star and 1 to ask a question. The next question is from the line of Pranav Gandhi from Lotus Wealth. Please go ahead.
Hi. Congratulations on the great numbers. I had a couple of questions. The first one is that in the PPT, it's mentioned that we've commercialized 24 products in the U.S., but we've only launched one, like, in Q1. So what's preventing us from faster product rollouts?
I think your voice was not clear.
So Pranav, I think your question is why we have only launched 2 and not more in the quarter.
Yes.
It's all launched.
No, it's a function of, an ongoing process, which,
Yeah, no, so all are launched. It's not that 2 were additionally launched, right? So remaining all are already launched. It's not that we can only launch 2 out of 24. So, all the products that we have approval for, we have launched. And then the number I think you are probably seeing is 70, that are all 70 approved ANDAs, ANDA products. A lot of them are acquisition products, right? So we'll be in the process of launching them in coming quarters. So, probably some will be launched next quarter, and then going forward, every quarter we'll have few launches from that acquisition portfolio that we have.
Okay, wonderful.
It's a process.
Yeah.
It's a process of, once we have the ANDA, we approach our marketing partner, and then the whole process, it's the cycle. Then there are a lot of trials, and, it's a process. It doesn't happen automatic. But I think predictably, you will see more launches every quarter going forward.
Wonderful. And just another question. We've got 719 products under registration in emerging markets. So, like, how do you prioritize regulatory filings and manage the associate costs and timelines? Like, what are the timeline structures in the emerging market segment that we have?
Correct. So, on emerging markets, each market regulatory functions very, very differently because each market has a different dossier requirements, each market has a different samples requirement, and the review cycles also differ from market to market, right? Probably in our presentation, you would have also seen what is the breakup of those 719 region-wise. As you can see, each region demonstrates a different opportunity put together. So, very difficult to pinpoint that what 5 products would work and what 10 products would work. But largely speaking, we would have an approval between 12 to 18 months for those 719 products that are with the MOH. So say by 18 months from today, we would have about 718 products will get registered and ready to be launched. In a hindsight, if I have to summarize that number.
So don't we have certain products which are under the latter stages of these developments?
Can you be a little more clearer, please? Because
I'm saying, don't we have certain products, like certain number of products, which are already in the latter stages of this process?
Which are already in the
latter stages of this process.
Latter stages of approval.
Later stages. No, they are, right? So as I said, in 18 months, I expect all 719 to be approved and launched, right? Now, that could be 20% of the 719 could launch in next 3 to 6 months. 20% of 719 could be launched in 6 to 9 months, right? So they are all at a different stage of evaluation. They are all at different stage of approval, right? So as I'm saying, as a period of 18 months, we expect all 719 to be approved, and by that time we would have another 500 plus under registration, right? So that keeps on going, in terms of emerging market registration in different markets.
Perfect. Thanks a lot.
Thank you.
Thank you.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Good afternoon, sir. Great figures, so that's a good thing. And in terms of the CDMO revenue in regulated markets, how do you see that over the next 2 years, particularly in FY26 and FY27? And number 2, what is your current order book? And typically, what is the execution time frame for this order book?
So, two questions, right? So one is, currently this year, we've said we'll do about 400 odd crores from the U.S. side of the business. And typically, as we discussed, 50% would come from a CDMO, CMO. That's about 200 odd crores that will come from CDMO, CMO segment. That's our this year projection. Going forward, as I said, about 20-30% CAGR growth is what we expect out of our U.S. side of the business. So typically, if we keep the same split on the business, that will give us that kind of visibility on the CDMO, CMO side of the business. As far as order book is concerned, again, as I said, we have order book spilling over all next 12 to 15, 18 months. But coming to those numbers of 200 odd crores for this year should be able to achieve for current year, as I understand.
So what is the current order book? Sorry, I didn't get the right answer.
I think about 23 million for CDMO. About 23 million for CDMO, CMO. US dollars.
So Sanjay, this $23 million is as on today, am I right? Post is the first quarter.
Yeah. As on today.
Correct.
As on the beginning of the quarter.
Okay.
Current quarter.
Understood.
Yeah.
Understood. And when you look at, say, 200 crore kind of a revenues in FY26 from this business, in FY27, do you expect, kind of another 30-40% kind of a growth based on the pipeline?
Well, we said, I think we would be able to guide 20-30% CAGR going forward. I think very accurate projections we'll be able to give by end of this year, early next year. I'm saying calendar year. That would be a right time for us to kind of give very accurate growth projection for the next year.
But we are also adding capacities in anticipation, the third round and the fourth round. So we see a very decent pipeline. There are a few other developments also on which we are working. So it's a function of, multiple factors. But yes, 100% strong growth going forward, over 25-30% as Swapnil said.
And even we have an extremely busy year this year in terms of launches. So as you know, a product gets launched today, it takes 6 to 9 months to even achieve that kind of big sales number, because you sign contracts get materialized and the supplies start. So even though launches that will happen in second half of this year will have its peak next year, So you will see. I think probably I know you want us to give us guidance for the next year, which I think right now we'll stick to about 20-30% CAGR going forward, but we'll have an accurate number by end of this year.
Just to clarify on this, because in the opening remark you said that your guidance for FY26 is a revenue growth of 50% and 100% net profit growth. Am I right?
This year, that's right.
Correct. And at the same time, you also said that your CDMO kind of a growth. Current year, you are looking at about revenue of roughly there you said about order book is $23 million, and this gets executed over what? This will be about 12-15 months, 12 to 18 months?
Yes. No, this will be, so I think the system of order book is something that you need to understand. So what we do is we get long-term contracts and then rolling orders. Okay. Now, what happens, the firm order book we talk about is the firm rolling orders that we have already got from the partners. There are quite a few discussions which are also on table. So now it is not something like an EPC contractor कि मैं बोलूँगा कि ये 23 is in this year going to be executed. Part of it would be rolled over, part of it would be substituted by fresh orders. But I'm what we are trying to say that we have decent visibility to guide that yes, ये साल 200 crore हो जाना चाहिए without any difficulty.
Okay. It means even the non-US business, you are looking at good growth even from the non-US business.
That is the emerging market part, yes. So उसमें there are three things. One, my API is coming into production, full production this year. And though a backward integration activity, some business will go out. Second, the emerging market portfolio is going to be much stronger than what we have done last year. So we expect a very good growth on the emerging market. More importantly, moving into the positive margin territory on the emerging market side. And then the branded generics, as Swapnil explained, about 40-45 crores we are expecting. Bulk of it injectables, hospital supplies, and that too is growing quite rapidly. So pura milake, we have guided that we should do definitely about 600 crores top line this year, 600 to 650 as the range that we have talked about, and a very, very strong growth in profitability as well.
Good, sir. Great, sir.
Now, we are on shifting sand. There is nothing firm, but overall, जो indications है, इसके basis पे that confidence is, coming to us that yes, itna to there will be some compensation here and there, some vertical taking care of a little higher growth, something not exactly happening the way we want because we are dependent on so many partners. But this is what we are confident to deliver this year.
Great, sir. Wishing you all the best. Thank you.
Thank you. We would like to request participants to limit the question to 2 per participant. The next question is from the line of Yash Shah from Aditya Birla Sun Life Insurance. Please go ahead.
Hello. Hi, sir. Congratulations on a great set of numbers. So I just had one question. I'm not sure if you answered that. I joined the call a little bit late. We had a delay of around, because of the delay, we were not able to record around 15 crores of revenue in the previous quarter. Has that come in this quarter? This is the only question which I had.
Yes, hi, yes, thank you. Yes, that revenue is partly been coming in this quarter, and that's also reflective of our quarterly results. And part of it is probably going to be in this quarter as well.
Okay. So about okay, got it. Sir, one more question which I had was on the CDMO side. We just mentioned that currently we are sitting on an order book of around 23 million. So from how is the order book looking like on the CDMO side? Like, is there any broad number which you can give till the end of the year? What is the amount of order book that we expect to sit on?
Yes, I think, the good number to talk about right now is what we have said. As Sanjay Bhai just pointed out, there are multiple discussions are happening on CDMO side with multiple partners. And then, as you know, there are a lot of development contracts, right? So development takes about 12 to 15 months before the product gets filed and so on and so forth. Some of the CDMO work that we've done a tech transfer, we have qualified a new API source that also goes into PS, which takes about 8 to 10 months for us to get approval, at least 12 months in some cases. So those are the things are all there. What kind of revenue projection from a time frame standpoint we can give, I think it will be a little tough because there are regulatory approvals that are also needed. So as we move forward, I think we'll be able to give better upward guidance on the CDMO side of the business. But today, as we speak, I think the numbers that we've given is quite comfortable, and we're quite confident of meeting those numbers for the current year.
Perfect, sir. Perfect. Thank you. That's all from my side. All the best, sir.
Thank you.
Thank you. The next question is from the line of Thomas Abraham from Mirae Asset. Please go ahead.
Hi. Congratulations on a good set of numbers. Most of the questions have already been answered. If it's possible to give a further few more details regarding it. One would be in the regulated market and the emerging markets, what is the geographical breakup? So if I'm looking at country-wise, what would that be like? And where are we expecting in these areas? Where are we expecting the highest growth or higher growth numbers? Secondly, in terms of capex, are we looking at? You mentioned a good order book as well. So in terms of the order book, are we looking at additional capex to be able to deliver for this order book? And to what extent would it be in terms of the manufacturing side of it and any other aspect as well where the capex would go into?
Yes, thank you, Thomas. So on the regulated side of the business, currently our most of the revenue comes from the US. So whatever the growth guidance that we've given is US focused. That's number one. On emerging market, our top markets have been part of Africa, which is Ghana, Tanzania. On Middle East, we have Yemen, Kuwait. On CIS, we have Azerbaijan, Georgia, Uzbekistan. On Far East side, we have Myanmar, Cambodia, Philippines. So these are our top markets. Latin America also, we've added Bolivia, Guatemala, Ecuador. So these are our top markets on the emerging market. Now, breaking out market-wise revenue would be misleading because each quarter will represent a different mix. So these are the top markets. I would probably want to stick to that. On the capex side, as we already discussed, we have 2 manufacturing lines that are already operational in the US. The second line has been operational for almost last 6 months now. Third line is almost about to be completion, which will get operationalized in Q3 of this year. And fourth line, which we are planning to install, will be end of this year. So those are the four lines on the oral solids that we are planning at the US facility. And tentative capex is going to be about
around 200, yeah.
About 2.5 million in the US. We are also strategically looking at our manufacturing setup in India, which would also help us cater to the markets that we are not currently catering it to. So markets today that we don't have any businesses, Brazil, Mexico, European Union, very small business in UK, but EU, a couple of countries, but not largely we cater to. South Africa, very small business catering it from the US side, but we can still do a lot more business with our existing product pipeline that we have. Australia, New Zealand, couple of those markets. Now the beauty, or even Saudi Arabia for that matter. Now beauty is in this market, any US approved ANDA, we get expedited review and products get commercialized very fairly quickly. So once we have the setup and US approved products that we have, we'll be able to access this market in a much faster way compared to a completely new development that one undertakes. So those are the things also we are looking at. Overall capex, I think we'll do it in tune of 150 crores this year. We've said 250, but I think looking at where we are, I think 150 would be the right number of overall capex between US as well as India is what we anticipate for the year.
Part of it will spill to the next year. So this year actual about 150 and then spill over of 50 plus next year. Yeah.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Naitik Mohate from Sequent Investments. Please go ahead.
Good afternoon, sir, and congratulations on a great set of numbers. So my first question is regarding our API facility. So the API facility which we have recently commissioned, so I think we were planning that we would get a US FDA for the facility somewhere around Q2 this year. So is it on track? Have the officials come for inspection, and what is the progress and timeline like?
Yeah, so Naitik, I would love to get it inspected this year. But I think what we said is Q2 next year is when we expect FDA to come and inspect. Why we are confident of them coming next year? Because the product that we are filing DMF for, we already have an existing commercial product in the US. So only on that product we are qualifying as a second source. So the approval timeline is very definite for us, and the inspection timeline is also very definite for us to get triggered on the API side for the US business.
Okay, so this would be sometime in Q2 of calendar year 26.
That's correct, yes.
Yeah. Okay. So my second question would be like, what are the...
Yeah, please go ahead.
Yeah, my second question would be like, what are the top 5 products for us in the CDMO, and what is the percentage of, like, what is the top 5 percentage as total CDMO sales?
So, due to our obligation with, we've got NDAs in place with our customer and partners, so we are not able to disclose the product names. But top 5 product will contribute about, again, 60 to 70% of all the entire CDMO business that we have.
Okay. So, sir, do we believe as the CDMO business ramps up in FY 26 and 27, this percentage of top 5 products to drastically change?
I don't think so. I don't foresee that to change drastically.
So another question would be, have we...
Sorry to interrupt. Mr. Naitik, may we request that you return to the question queue for a follow-up, as there are several participants waiting for the turn?
Sure.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Hello.
Yeah, hi. Yeah.
Hi. Firstly, congratulations on a great set of results, sir. Hopefully, I'm audible.
Yeah.
Hello.
Thank you.
Yeah, sir.
Yes.
So I think a lot of my questions are already been answered. So just wanted to know, like, current year emerging market business, we hope to become profitable. So what would be the, is it breaking even right now, or maybe you're expecting in H2 for it to breaking even, or how is it right now, boys, sir?
See, we have done about 6% EBITDA in the emerging market. We believe we should reach closer to double digit, hopefully. At least around 10% is what we are believing. See, what happens as the new registrations kick in, you commercialize them, it takes time to reach a reasonable level of volumes. So I think 100% next year, we should be in mid-teens in the emerging market in terms of EBITDA. This year, hopefully double digit. That's what the target is.
Okay. And on like what basis, like on PAT basis, it's going to become like profitable at 10% or mid-teens? What level would it be like profitable at, sir?
Yeah, on PAT basis, we should be, I think, marginally positive this year.
Oh, okay. That's great to hear, sir. So like next year also our margins can improve even further from what they are currently because
Definitely.
yeah.
Yes, definitely.
Oh, okay. And sir, also wanted to know, like, we have like the backward integration also going, and we also have we also raised funds for inorganic opportunities. So how is that going on, sir? Have we got a target that we want to acquire, or what's the timeline for that process, sir?
So inorganic growth was largely on product side of the business. We have already done close to 20 plus end acquisitions so far, and we'll be continue to look for more as long as it fits in our strategy. So that's been our focus, and that's what we've been executing as well.
Oh, okay. Perfect, sir. And just like last one bookkeeping question from my end, sir. Our tax rate, what do we, visualize that as? Because I think year on year there's some fluctuation because I understand there's some element from US, some from India. So what do we, can take as a rough tax rate, sir?
Tax rate should be around 20% on an average.
20 okay.
29, it will be around 20%.
Oh, okay. Perfect. So yeah, that's it from my side. So all the best, sir. Thank you.
Thank you, Darshil.
Thank you. The next question is from the line of Vivek Gautam from GS Investments. Please go ahead.
Yes, sir. First of all, congratulations on good numbers. Second question was about the negative cash flows. So, is this negative cash flow a story of the past with the company coming into positive cash flow in this first quarter?
No, so this quarter we've had 11 crores of operating positive cash, and sorry, I missed your second question. What was it?
Is it a past?
No, basically, yeah.
Yeah. Of course, that's been a past thing.
100%.
Yes.
Okay. Now, what were the factors contributing to it, sir? Earlier, the company was in negative cash flow, and what were the factors behind our company turning into positive cash flow, sir?
Negative cash flow is a function of continuous growth and reinvestment. I think it's a bit early for us to tell you that what percentage of the cash would be as a surplus positive cash. Let's wait for a couple of quarters. We have a lot of growth still coming, but we are very confident of continuous positive cash flow from the operations.
Okay, sir. And second thing was about the business in the emerging countries. There was a lot of complaints on that cough syrups and poisoning and leading to death, and lot of inquiry by the Government of India and World Bank who are funding it. So basically, how is our company taking care of it, and we are totally away from that, sir?
We are totally away. We don't do any cough syrups. Zero. Whatever registration that we have had, we've discontinued those.
And our other product range is totally safe in that manner, sir. Yeah.
Correct, yes.
Okay. Thank you, sir. Keep up the good work.
Thank you.
Thank you. The next question is from the line of Umesh Matkar from Sushil Financial Services Limited. Please go ahead.
Yeah, thank you for the opportunity. So first of all, I would like to know how are you going to fund the expansion plans that you have in US and other regions? And second thing, what are the risk factors that you see for achieving your revenue top line of around 600 to 650 crores? Thank you.
Yeah, so CapEx is going to be serviced from internal accruals, part of debt and part of our IPO proceedings, so all three combined, depending upon what and how we require the funds. And the risk factors of achieving 50%, I mean, there could be some regulatory risk, there could be some foreseeable risk that we already know, right? We don't foresee any, or maybe some outrageous discussion on the tariffs, right? I mean, which we don't anticipate, but you never know, right? So those are those industry standard risk factors that you would see in which leads by any pharma company, I don't foresee anything over and above that what the industry risk factors are.
No specific risk.
No specific, yes.
Okay. Any price erosion risk that you might see in US, especially in a non-CDMO or controlled substance business?
Correct. So our dependency on each product revenue is about 2.5% of total revenue that we have. So there could be price erosion, as you rightly said. Our exposure towards retail is limited. But even if there's a price erosion that comes in on that particular product, my exposure is only 2.5% each one. So even if that comes in, on a console basis, I'm kind of protected. Plus, there's a existing product portfolio expansion that happens, right? The new product approval that comes in, new product launches that will happen, whatever that small little erosion that could come in, that will fill that gap and give us that continuous growth that we've anticipated. So anything that we have projected for this year, I think those factors are already being taken care of as we speak. So we don't foresee a major or even something that could hurt us in terms of our guidance that we've given.
Right, sir. And last question, can I have a breakup of therapeutic areas that we cater on a total basis? If I missed it earlier.
We generally don't give out therapeutic area-wise breakup, but is there anything specific to any product that you would have? Probably we'll be able to answer it. But generally, the way we track our business is the US business, which is compromising between two verticals, our own product vertical and a CDMO. But the therapeutic areas that we work is across the board. Like we have pain management, we have infertility, we have cardiovascular, CNS, antidepressants, endocrine, SSRI, calcium blockers, muscle relaxant, respiratory. So these are all different therapeutic areas that we work across.
Okay. Yeah, that would be it. Thank you very much and wish you all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Shreya Chatterjee from Ageless Capital Finance. Please go ahead.
Hello, sir. Thank you for taking my question. Congratulations on a fantastic set of results. So my first question is a bit more on the strategic side. Like you mentioned about Senores, capability in complex generic therapies, CGT, and the controlled substances. So I specifically wanted to understand what R&D capabilities does Senores have, and if you could also give some color onto the quality audit certifications that are required for your manufacturing centers. Thank you.
Yes, thank you, Shreya. So on on the R&D infrastructure, we have currently 2 R&D centers. One center is in India, and the second center is in the US. So almost all products for emerging markets and products that are non-controlled are developed in India, and then they are tech transferred to US site, whether it is CMO, CDMO, or our own side of the product. Anything that is on the controlled substance side, our 100% development happens in the United States. We have about 12 people in R&D in the US as we speak. So that 100% development is done there. As far as quality audits are concerned, we, of course, US plant is FDA approved, and our Indian plant, formulation plant that we have WHO GMP approved, and we have multiple MOH approvals from different countries, starting from Kuwait, Yemen, Philippines. We have Peru, Digimed approval. We have got few of Azerbaijan and couple of other markets that we have, Tanzania, Kenya, those approvals we have on the emerging market side.
So I wanted to understand more on the R&D side. Like, is there any specific capability that Senores have which is helping it to win in this competitive space? If you could maybe point to some technology.
Correct. So our R&D is headed by a very proficient gentleman who has got experience on handling a lot of oral solids, complex oral solids across, right from a basic IR to ER, XR, sublinguals, ODT, chewables, tablets, pellets in capsules, multiple coating technologies. So a lot of those aspects of the business on the R&D, which is typically driving the oral solid, we are able to do everything, right? So that speaks for our R&D development or R&D capability that we have with our people and the infrastructure that we currently have. On injectable side, which we cater to on emerging market, we also do vials, ampoules, PFS, Decode injections, multiple those different type of manufacturing capabilities that we have on the injection side as well. So put together, I think I would say very good R&D capability on the markets that we cater to and the kind of product range that we have today.
So just to add, I think 6-7 strong team in US and a 12 strong team in US and 50+ in India.
Okay, so and then if I understand.
Sorry to interrupt. Ms. Shreya, can I request you to return to the question here for a follow-up question?
I'll just finish it. So novel formulations is something you're looking into for the controlled substance. Is my understanding correct? Just to understand.
Yes. So, we are looking at ODTs, sublinguals, chewables, which are those novel formulation on existing products through our NDA and 505(b)(2) route for the US. That's the complex area that we work upon. That's a continuous development, that happens at our site.
Thank you so much.
Thank you.
Thank you. We'll take the last question from the line of Mitesh Mehta from Long Term Investment Group. Please go ahead.
Hello.
Yeah, Mitesh.
Hello. Yeah, congratulations for good set of numbers. My first question is regarding revenue share, proposed revenue share in 3 years, like we are moving on to emerging markets as well. So what would be, say, revenue split among emerging and North American markets, say, 2 or 3 years down the line?
Difficult to predict, but I think we'll still maintain a lead around on an average 60-40 का ratio abhi rahega. This is what our belief is. But I think we'll see. But at least for this year and next year, minimum 60% from regulated and 40% around emerging.
Okay. And second and last question is regarding any plans for foray into domestic branded markets, say, a few years down the line?
Sir, we are already present in domestic branded generics market. We have about 80-85 people, field staff, and we are currently present in about 22 states. We are also approved in almost top-notch pharma hospitals of India. Right from Apollo, we are approved in. Sahyadri, we are approved in. AIMS, lot of AIMS locations we are approved in. PGI Chandigarh, also we are approved in. So lot of good reputed HLL also we are approved in. So lot of good reputed hospitals across India, our products are currently being distributed and administered.
So this is hospital segment predominantly, huh?
And what would be the revenue share of local generics or branded generics local market? Revenue share.
We targeted to do about 50 crores this year from our branded generics vertical.
Okay. Thank you. That's it for my side. All the best.
Thank you. Thank you very much.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for the day. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. I would like to once again thank everyone for joining our earnings call. We will keep updating the investor community on a regular basis of the developments at Senores. I hope we have been able to address all your queries. For any further information, kindly reach out to us. We'll be more than happy to address those. Thank you once again.
Thank you. On behalf of Ambit Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe for latest upcoming videos.